We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Garofalo, CEO and Chairman of Gold Royalty Corp. David, thanks for joining me today.
Thanks for having me on, Tom.
Great to have you. And, I've been looking forward to this interview for quite some time. You were the former CEO of Goldcorp, one of the largest miners in the world at the time, but you've deliberately positioned yourself now in the development stage end of the spectrum. So what factors led you to this decision?
Well, I think the reality is reserves have been declining by about 40%. That's the bottom line over the last 7 or 8 years. The dynamic behind that is the fact that the established producers have not been reinvesting back in exploration or replace depleting reserves. Their focus deliberately has been on deleveraging, and now we have net zero debt in the gold industry, which is unprecedented. It's been on returning capital to shareholders. It's been on harvesting the existing business because 10 years ago when we were last at peak gold in terms of the price, market price for gold, around $1,900 an ounce, there was a massive amount of investment in new mine development, both in the precious and the base space. And so we saw a vast escalation in operating capital costs and eroded the margins that investors were looking for. So coming out of that and that hangover, the industry has been rightly focused on delivering returns to shareholders and driving up margins. Now that's gone a little bit too far. The pendulum swung a bit too much. And the industry needs to invest back into development. And I think there's going to be an avalanche of capital that goes into new mine development, both on the base and precious side, as both metal prices are quite robust right now. We're at an incentive price right now for both gold and copper development. This is the time that you're going to see a rapid deployment and massive deployment of capital into mine development. And that's why I'm positioning myself at that end of the spectrum, both in terms of running a precious metal investment fund focused on exploration, but the royalty business is an important part of the ecosystem to help and incentivize mine development because royalty companies access capital more cheaply and then deploy that into new mine development and take royalties back.
So I'd like to get to the royalty side of things, David, but as you were mentioning, basically the fundamentals for how the gold space is operating right now with no debt and all of those considerations, do you think that this has been one of the, let's say, the best shape that the gold industry has ever been in?
It is financially, absolutely. That's entirely the case. The balance sheets are squeaky clean. Nobody's been raising equity in any significant fashion, so there hasn't been dilution. There's been returns of capital in the form of dividends, share buybacks. So the industry's done a great job of harvesting their business. Where they're in terrible shape is in their reserve base. So the average reserves for global mines 7-8 years ago was about 20 years. And today it's 10 years. So it's been cut in half. So they've done almost too good a job of harvesting their business and not taking some of that profitability and reinvesting it back into those depleting assets.
So as we're speaking here on the afternoon of Monday, April 26th, it was announced this morning that Fortuna Silver was taking over Roxgold. So do you think M&A in the space is starting to pick up, and is this a good sign for the industry in general?
Well, if you're not finding ounces, you're going to have to buy them, and the industry clearly has an existential issue with the rapid deterioration of the reserves. So, of course, there's going to be an M&A. It's an imperative for there to be M&A because generally from discovery to first production, it's a minimum of 10, 15, often 20 years. So you're not going to see a turnaround in production profiles unless you go out there and acquire new mines to replace your depleting reserve base. And that's why Newmont and Goldcorp merged several years ago. That's why Barrick and Randgold merged. So the top end of the pyramid has done their merging. There really isn't any seniors that are really going to be able to merge with each other. It's going to be in that mid-tier that's become significantly populated with new entrants, emerging producers. There's almost too many of them. There's going to have to be a rationalization because of the dynamic we've seen in reserves globally.
Has COVID basically caused a lost year from your standpoint in the M&A sector?
Surprisingly not. It may have been more pronounced if it weren't for COVID, but there's been a lot of M&A in the space. a large volume of smaller transactions. As I said, the bigger guys have already done their M&A. They're unlikely to undertake any more on M&A. So it's really going to be focused on the mid-tier and the emerging producers. And that's been happening. And so there's been a large volume of small dollar transactions. And I think you'll see a pickup in that because there's been an impediment because of lack of the ability to do physical due diligence. So there will be more M&A. I see a big pickup once we exit the COVID crisis that we're currently experiencing.
So, David, how important will scale, efficiency, and diversification be for majors in this coming bull market?
Look, scale is extremely important, and that's been demonstrated in the gold industry and the mining industry generally. Large institutional investors, the generalist investors who by and large have not participated in the gold business in a significant way, require scale because they need liquidity to get in and out of the stock. And even if you took all of the mining companies and collectively look at their market cap, they're still smaller than Apple. It's still a relatively small industry. So we have to compete against other industries to attract that generalist capital. So scale becomes extremely important. So that's one of the reasons that in addition to the dynamic on reserves, you're going to see a drive to M&A to achieve that scale. So some of these companies can start to graduate into major indices and attract that outside capital.
So do you think the gold industry in general has learned lessons from the past, or are we doomed to repeat the same mistakes as in past cycles?
I think yes and no. I think what the last several years has demonstrated in the gold industry in particular, and for that matter in the base as well, is companies are very good at harvesting their business profitably, deleveraging. They've really done a very good job of repositioning their balance sheets and making them as sound as they've ever been in the entire mining industry. But the reality is the significant underinvestment that we've experienced in the mining business over the last several years is going to come to roost. I think there's going to be a competitive allocation of capital from both base and precious into new mine development because the reserve dynamic is the same in base as it is in precious. It's been down in a significant fashion for a long period of time, but the demand is still very robust. So there is a big demand supply gap that will have to be filled. And I'm afraid, that capital will be deployed from every angle, every perspective in the base and precious side. And I think we're going to see rapid cost inflation in the industry. I think it's going to happen again. So from that perspective, we haven't learned. We've underinvested for too long, and that's going to have to come to roost, I think, in the short to medium term.
So, David, you've worked at really every end of the gold spectrum, basically for a major producer, a junior, and now in the royalty space. So, how do you look at the way in which capital is raised by the juniors? In your opinion, is it more advantageous for them to raise capital through a royalty deal rather than doing placements?
It's really a cost of capital driven decision, and I think by and large, until the last year or so, juniors really couldn't raise equity in the general equity markets. It just wasn't available. That started to open up a little bit over the last year or so. And we're starting to see juniors start to get capital again. But royalties have become a very competitive source of capital for the juniors that are looking to reinvest back into exploration. And so, as I said, royalty companies are an extremely important part of the ecosystem as the industry starts to renew its focus on exploration and mine development.
So is part of the idea that you might have in this model to provide these juniors with guidance and support from an experienced team like yours?
Yeah, in when I was at Agnico, at Hudbay, and at Goldcorp, we ran incubator funds in each of those companies to invest back into exploration because by and large, the juniors were not having a lot of success and tapping into the equity markets, at least on a consistent basis. And for us, it was extremely important that the juniors were successful. The reality is the established producers do a terrible job of grassroots exploration because that's not their skill set. When you're running a junior, you have to embrace risk. When you're running an established producer, you have to avoid risk. You have to mitigate it at every turn. It's about mitigating risk from a safety perspective, environmental perspective, capital cost risk, operating cost risk. It's all about risk aversion and risk mitigation. When you're a junior, you're much more entrepreneurial. You have to embrace that risk. You'll have to try to hit the home run every once in a while and strike out. That's the reality is juniors 19 times out of 20 do strike out. And so we saw the importance of making sure they had a consistent source of capital as an established producer so they could do what they do. And in fact, what we were doing is effectively outsourcing that grassroots exploration because we recognized that wasn't a core competency as an operator.
So do you find your experience of running a major is instructive to thinking about risk when you're looking at these juniors?
Yeah, when we're investing in royalty opportunities, we're doing it from an operator's perspective, and that was a deliberate choice by Amir Adnani, the co-founder of Gold Royalty, and myself, to populate our board management with operators. And so, in addition to me, and I've been in the mine development and operations side for over 30 years. I have Alan Hare on my board. Alan was my successor at Hudbay. He was my chief operating officer at Hudbay, 35 years as a metallurgical engineer and a prolific mine builder. Warren Gilman, who runs Queen's Road Capital, Li Ka-shing's natural resource fund out of Hong Kong, he is a very, very capable former investment banker, understands the business inside out, comes from a technical background as well. We have Ian Telfer as the chair of our advisory board. Ian built Gold Corp. He founded Wheaton Precious Metals, where it's not an accident we're replicating that model by spinning Gold Royalty out from gold mining. And then in addition to that, I have John Griffith, my chief development officer, who spent 30 years banking the industry, a lot of royalty engagements that he had. Alistair Still, who's my head of technical services and is also the CEO of Gold Mining, is a very experienced operator, mine builder, and did M&A work for us at Gold Corp in the last few years I was there. So really, we are trying to distinguish ourselves from the other sub $1 billion market cap royalty players by staffing ourselves, in fact, overstaffing ourselves with people with strong operating pedigree, which gives us a clear-eyed view of the underlying risk of the royalty opportunities we're investing in, but also gives us a very, very deep Rolodex and network that we can leverage to look at royalty opportunities perhaps before they're available to the rest of the market.
So when we look at the projects in Gold Mining's portfolio, are these projects that will be advanced by drilling and developing the resources more, or are they just kind of a set and forget type of idea until we see the gold price rise some more?
Well, initially it was the latter, and Amir was quite a visionary in picking up these assets in gold mining at 10 cents on the dollar during the bottom of the cycle. He paid about $80 million in gold mining stock to buy assets that were trading collectively north of $800 million market cap in the previous cycle. And so he bought them, he put them on the shelf, and he waited for the gold cycle to turn. Now that cycle has turned. We're at, as I said, the incentive price for new mine development. Now the objective with bringing Alistair in, who's a capable mine builder and operator, is to start to staff out the project team on gold mining and start to attract outside capital into the projects in the form of exploration and eventually studies, PEAs, pre-feasibility studies, feasibility studies to de-risk these projects and demonstrate their economic potential so we can start to attract outside capital, both from the marketplace into gold mining, but also from established producers who are clearly starved of development stage opportunities. And collectively, those gold mining assets have 26 million ounces of gold resource and over 31 million ounces of gold equivalent when you include the substantial amounts of copper and silver byproduct that's inherent in those projects. So there's a lot of resource in that collection of a dozen projects. And in fact, if you look at that collective resource, it's bigger than the reserve and resource of some of the bigger established mid-tier producers in the gold industry. That's an enviable position to be in an industry that's starved of projects. This will attract interest from the established producers. And as Alistair de-risks these opportunities, re-rates them in the marketplace, we're going to enjoy the benefit of it at Gold Royalty because we have royalties in each and every one of those dozen development stage projects.
So I know you were speaking in the past about basically focusing on listing Gold Royalty on the NYSE instead of the, let's say, TSX. Is that simply due to trying to attract that capital that you're talking about?
Yeah, look, we've gone to what I would say non-traditional source of capital for this royalty opportunity. And what that will give us is a much deeper source of capital as we look to grow the business. And we'll grow the business through a couple of ways. One is we'll start to write royalties on development stage opportunities. We'll buy some existing royalties that are sitting in the hands of smaller prospectors and whatnot that are looking to liquidate the wealth that they've created by putting royalties on their discoveries. And also there's a proliferation of sub $1 billion market cap players in the space. They need to be consolidated. There's been a significant number of entrants into the royalty space in that sub $1 billion category over the last couple of years. There's too many of them now. And now we have to start to go about the business of consolidating. And why we put such a strong board of management in place is we see ourselves as a survivor. And I would say among that category, we have by far the largest mineral endowment underlying our royalty position. So we're the biggest in terms of attributable ounces to our shareholders. So we have scale, and now we're going to create scale by consolidating, I think, some of the smaller players in the space and creating that scale in the marketplace to attract those generalist investors into the story.
When you were saying that you guys are a survivor, what does that mean to you, David? And why do you say that?
Well, survivor means that we're building a sustainable business for the long run, which means we operate under very stringent criteria. And when we allocate our capital, we're doing so with a view of growing the net asset value of our underlying business. Clearly, with $90 million in our treasury, we had a very successful IPO that we completed in early March. We have also by far the largest treasury among those sub $1 billion market cap royalty players. Now it's about deploying that capital like any financial institution would. And I really look at royalty players as a financial institution, a bank, if you will, to the mining space. Do so with expecting to get a strong return on that capital in the form of royalties, which gives us a steady cash flow, but also gives us leverage to the exploration upside that the operators that we've invested in hopefully achieve as they drill out their deposits.
So when we look at majors in the space, thinking about taking over smaller projects that are ounces in the ground, are they going to look less favorably upon a project like that has a royalty attached to it rather than one that doesn't?
Well, certainly it enters into the economic analysis. But what we want to ensure is that when we do put a royalty on the property, we don't encumber it economically. We don't impair it in any way. And a royalty is, in the financing that comes from a royalty, provides a very important source of capital to that early stage exploration that hopefully allows the deposit to grow geologically and make it much more interesting economically.
So turning a little bit, David, to your views on the fundamentals of gold, what would we have to see for you to become less bullish on the gold price at this time?
Well, I would have to see a rapid increase in real interest rates, an end of quantitative easing, and nothing like that is on the horizon, particularly considering the uncertain economic environment that we find ourselves in. And I would say that predated even the pandemic. I think we were in a period of sustained lower interest rates for the foreseeable future, both on a nominal and a real basis. And even if we started to see nominal interest rates creep up, which has been suggested by both the Bank of Canada and the Federal Reserve over the next couple of years, the reality is, given all the quantitative easing that's been introduced into the market, we're going to see a lot of inflation. So real interest rates are unlikely to go up and in fact could go down further. They're negative now and they're likely to become more negative as we see more pronounced inflation. That's very, very bullish for gold. Historically, gold has been a very accurate barometer of those inflationary pressures. That's why the gold prices have the run it's had over the last couple of years and is likely to have a sustained run from here. Gold in 1981 was $850 an ounce. That was actually the real all-time peak. Because in today's dollars, that would be about $3,000 an ounce in 2021 dollars. So we're a long way from there. And I would say the amount of quantitative easing that we're experiencing now is unprecedented. It certainly far exceeds what we saw in the 70s and early 80s when we had hyperinflation.
So some criticisms of gold have been that it has no yield. But when we contrast it with the state of the US dollar or other fiat currencies right now, why does it look even more attractive now than ever?
Well, the reality is sovereign debt has no yield. In fact, with inflation, and in many cases, even without inflation, it's negative yield. And so your capital is steadily being eroded by inflation when you invest in sovereign debt, whether it's the U.S. treasuries, whether it's Euro treasuries, or even Canadian T-bills. You're seeing your capital steadily erode over time. Gold does not erode. Gold is indestructible. It's been recognized as a currency for millennia. And it's the one true currency that human civilization has accepted as a currency for as long as we can remember.
So Merrill Lynch has projected a $3,000 gold price. In your view, is this fairly conservative, David?
I would say so, and I think they're being deliberately conservative. I think they're taking that 1981 peak gold price and inflation adjusting to today's dollars. I don't think they pulled that 3,000 out of the hat. I think that's where it came from, if I were to speculate. But I think the potential for gold to far exceed that is there. I mean, all the ingredients are there, I should say, for that to happen. It's massive amounts of monetary stimulus, in other words, printing of money, extremely low interest rates, massive amounts of debt. Reality is no government in the industrialized world can hope to repay the debt that they've strapped on even in the last year. They'll inflate their way out of debt. And that is extremely bullish for the gold price.
So what about the silver price as well, David? Considering the historic price ratio for gold to silver, does this present another striking opportunity as well for investors?
Well, I think silver price has the potential to significantly outperform gold because, as you correctly point out, that ratio over time can be as low as 40 to 1. And I think we're closer to 70 or 80 to 1 right now. So in a rising gold price environment, people are looking for a proxy to play gold, something with a bit more optionality, and silver definitely offers that. So I do see the potential for significant outperformance by silver over gold.
Something you mentioned earlier, David, was that let's say the supply demand characteristics for gold have almost never been more favorable. But you also have a lot of experience dealing with copper. So why not position yourself in some copper plays as well right now?
Well, we do have quite a bit of copper within the gold royalty portfolio. As I said, we have 26 million ounces in gold mining's portfolio of just gold, but there's another 6 million, almost 6 million ounces of gold equivalent. That's primarily copper byproduct. It's about 2 billion pounds of copper within the gold mining portfolio. So we have significant exposure to copper, and those copper gold opportunities are going to become extremely attractive to both the gold and copper industry, in my view.
So is there let's say a particular reason why you don't focus, let's say, solely on copper? Is it maybe considering the fact that these large copper deposits are so hard to get into production and there's so many obstacles on that way?
Yeah, and that's absolutely right. And there isn't that perceived optionality in copper that you have in gold. People are there's a much larger population of juniors in the gold space because of that optionality, the inherent optionality in the metal. Copper is a very lightly populated sector. There are very few mid-tier producers in the copper space. There's virtually no junior exploration that goes on. It's really done by the seniors. And the reason that is because copper assets tend to be more scarce, as you correctly pointed out, but also tend to be much more capital intensive. They tend to be found in large bulk tonnage, low-grade deposits that require significant equipment and machinery, significant capital investment up front, long lead times. So you don't have that inherent optionality. Gold assets tend to be shorter in life, but much quicker to build than the copper plays.
And there's an interesting kind of distinction here, let's say, of really demand driving the copper price rather than sentiment driving the gold price. Is that right?
Yeah, look, you're right, absolutely. I mean, given the imperative to decarbonize our economy, copper is likely to see massive amounts of demand because copper intensity will increase dramatically as we look at electrifying vehicles, as we look at just decarbonizing the economy, and for that matter, urbanizing the economies in the third world. You know, that requires a lot of copper consumption in terms of electrical grids, appliances, machinery, whatever is required in order to migrate large populations, whether they're in China and India, from rural settings into urban settings. That's just going to continue to drive copper consumption for the foreseeable future, exponentially in my view, but supply is going to be extremely challenged.
So, David, do you think Bitcoin and cryptos in general have eaten some of gold's lunch? What do we need to see for gold to start making gains and getting attention again, like Bitcoin has had of late?
Yeah, no, absolutely. And I think, you've heard me, I think in the past, say some somewhat disparaging things about Bitcoin, but the reality is what's driving that dynamic and demand for Bitcoin is a desire for reserve currency. It's a recognition by maybe a newer generation of investors that, our fiat currencies are being undermined. How do I protect my capital? And at least, rightly or wrongly, they see Bitcoin as a preserver of capital in an inflationary environment, in an environment where the fiat currencies are being perpetually undermined by printing. My argument is cryptocurrencies, one, have no physical properties. There's nothing backing them. There's zeros and ones at the end of the day. And frankly, there's nothing that would impede the introduction of another cryptocurrency to take away market share from Bitcoin. So yes, Bitcoin has a finite quantity, much like gold does, But the reality is any market entrant can create a cryptocurrency which could capture people's and investors' imagination. And that would undermine the value of Bitcoin. With gold, since the beginning of man, there's been 200,000 metric tons of gold that's been produced. It's sitting in central bank vaults and on people's wrists and fingers, and would fill at most 4 Olympic-sized swimming pools. So volumetrically, it's tiny. We only, as an industry, produce 4,000 metric tons per year, and that's declining. So it's very, very high cost of entry, very, very difficult to create gold. You can't do it. And I'd say there's really no barriers of entry on the cryptocurrency side.
So when we look at, like, let's say the price of gold appreciating, the price of silver, the rise of these cryptocurrencies, are these acting as pools of capital to absorb all of this liquidity that's been injected into the system?
Yeah, and I'd say that's true of the general equity markets as well. We've never seen multiples price to earnings, price to cash flow as extended as they are now. We've never seen real estate prices, particularly in urban settings, in some of the bigger cities in Canada, just on fire. Money's free right now, and it's chasing a finite amount of hard assets, and that's really what's driving a lot of these valuations to unprecedented levels.
So as we take those different classes of investment, if we look at them all together, does this make the investment of gold at this time the most favorable?
It is. I mean, we've been range bound for a number of months and maybe even a year right now. Gold's been stuck in this range, and I think it's base building. I think we're going to see a very violent upwards movement in the gold price in the short to medium term, just reflective of the macroeconomic environment we find ourselves in, with a lot of stimulus being introduced into the system, and it's not going away anytime soon. Gold is a barometer of that. And I also see an exodus of capital out of the more speculative assets, whether it's the general equity markets, generally speaking, whether it's cryptocurrency that have seen a lot of volatility, a lot of upwards movement to unprecedented levels. I think you're going to see an exodus of capital back into gold, which has always been an anchor in people's portfolios for a long, long period of time.
Excellent, David. Is there anything else you'd like to share with us as we wrap up here?
Well, look, I think if you're going to play gold, you can buy the GLD. You can buy physical much more readily than you could ever. 20 years ago, GLD didn't exist. So it's open to not only individuals, but institutional investors to buy physical gold. But I would argue the best place for you to be if you want to invest in gold is in the royalty space, because it gives you optimal leverage to the gold price, because you're getting a percentage of the revenue. So as the gold price goes up, your revenue will go up and your return will, but also gives you exploration upside. So it gives you leverage to the success of the exploration efforts of the operators that operate those assets. The GLD, unfortunately, doesn't provide that. It provides you that physical exposure, but doesn't provide you the upside that the operators will start to achieve. And with exploration budgets now being reinflated in response to the downward trajectory in reserves, you're going to have a lot more exposure to that exploration upside within royalty companies like Gold Royalty Corp, which is GROY and NYC American.
Excellent, David. Thanks very much for your time today. If there's any of our listeners that want to find more out about you, you also post quite a bit on LinkedIn. Is that right?
That's right. And goldroyalty.com is our website.
Perfect. Thanks, David.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.